Jerome Powell just admitted that there are some banks that are in trouble right now, and it's something that they're really concerned about, and they're going to be watching as they look to make rate decisions going forward in the next couple of months. And so that's something that I do want to dive further into in this video. So guys, as you smash that like button, let me run that intro. What's up, guys, and let's get right into this. So you guys already know that Jerome Powell actually did not, or the Federal Reserve did not make a rate increase decision in the last meeting. However, they left the door open for further rate increases in July, and one of the major indicators that they are looking out for is how exactly do losses stack up in the banking industry. And so, a lot of bank investors already know that some banks are going to be in trouble. And this is why some of us are in the space looking for hidden value. And it's, the type of value that you can't screen for. And, although Jerome Powell does expect that there will be losses, I think this creates some opportunity for prudent investors who are looking to look or partner with institutions here that, may experience some losses or may make investors feel like they may experience some losses, but they're more diversified than appears on first glance. And I'll actually mention a name at the end of this video that they do call out, or the regulators call out, as a higher risk name. But, I did a full analysis of it, and it doesn't look like it's of that much risk. And so Jerome Powell goes on to say that he's keeping an eye on commercial real estate and watching the situation as it pertains to the banking system very carefully. Why is he keeping an eye on commercial real estate? Well, it's because there just seems to be a lot of risk in the space right now, and some of these buildings are no longer as valuable as they were pre-pandemic, could cause lenders to take some real losses. And this is what Powell said. He said that there's a substantial amount of commercial real estate in the banking system. A large part of it is in smaller banks. To the extent that it's well distributed, the system could take the losses. They do expect that there will be losses, but there will be banks that have concentrations, and those banks will experience larger losses. So we're well aware of that, and we're monitoring it carefully. So in other words, what they're saying is that they're worried that a couple of bad apples could cause real impacts for the system as a whole. And so I understand that. Now, here's the thing that I want to point out, and this is why I brought up this Reuters article. This is from back in May of 2023, so May 18. And the analysis here is essentially saying that overexposed U.S. banks to commercial real estate, especially office, could sell commercial property loans. And so right now, as loan losses remain very low, prudent banks could reduce office exposure right now by selling off some of their commercial property loans. Why does that matter? Well, there's an avenue here for a prudent banker. And, if you take some losses by offloading some of these loans, I still think your investors will be happy with you because, in this current environment, if you go out to your investors and say, you know what, we originally thought we were okay, but the economy has turned a little bit and we are uncomfortable with our commercial real estate exposure, especially in the office space, and we offloaded some of that. Yeah, we took a little bit of a loss, but overall, if the thing turns even more, we're well suited to last in this potential downturn. And so I think a lot of investors would be okay with a management team doing that. At the end of the day, if a management team did that and I got wind of it, that would be a management team that I would think very highly of, and I would consider investing into that particular bank if the opportunity, in terms of valuation, geographic diversification, et cetera, all made sense in that situation. But that would be one thing that I'd be looking for, because I think with banks, culture at the top really matters, and it's really difficult to stop writing loans, especially in certain areas where the yields are very high. I would think that commercial office space, the yields are very high right now, but is it a place that you want to prudently allocate some of your capital, especially if you're in a situation where you're potentially overexposed? And so, that's why I would look at that type of management team very highly. And so just going back to that Jerome Powell address to the reporters, he did say that this is something that will stick around for a while. And so he says, it feels like something that will be around for some time, as opposed to something that will suddenly hit and work its way to systemic risk. after stressing that the Fed is aware of the situation and monitoring it closely. And so here's where it gets a little bit interesting. Powell, in that same address to the reporters, later on said that if conditions tighten enough, that could be factored into the Fed's rate decisions moving forward. So if commercial real estate really struggles, the Fed will consider not raising rates. So that's very interesting. And what that tells us is that commercial real estate losses are something that we do have to watch going forward. And so the current environment of higher interest rates coupled with tighter lending standards following the bank failures will likely result in an increase in delinquencies of defaults. That's what everyone is sort of worrying about right now. But I had mentioned before that, they say right here, and I'll speak to it, but they're saying that there are subsectors within commercial real estate that seem to be holding steady, like industrial and multifamily. And here's where I go to my comment where I've mentioned on this channel before, not all commercial real estate exposure is the same. So when people say, oh, watch out for these banks, which I'll show you a list of later on, where they say, oh, they have a lot of commercial real estate exposure, value investors that do the work will likely find opportunities in those lists because not all commercial real estate exposure is the same. So you could have a bank that has a lot of multifamily exposure and not very much office exposure, and it'll be a lower risk in this environment. However, I would not invest in a bank that has a substantial amount of almost all multifamily exposure, because there could be an environment where multifamily becomes a risk. So the whole idea is investing in banks that are diversified across all loan types in as many geographies as possible. And so it goes on to say that the office space right now is most at risk. That's because of lack of demand following the shift to working from home. I would add to that and say that it's not all office space that has a lack of demand. There's different classes of office space. I think the office space, and I might be wrong here, but I think that the office space that is in most trouble is your Class B, Class C type of office buildings that are 20 or 30 years old. And the Class A buildings that are under construction right now, or the Class A buildings that exist right now, I think those are fully leased up, or they're still leasing up. It's those older buildings that could face some challenges in this environment. And so as you're looking through the portfolios of some of your banks, take a look at how much exposure do they have to Class B, Class C. And I actually own a bank, or I have invested in a bank that does have some Class B, Class C exposure, but they are also over providing for it as well. And so if the bank is providing for losses in this situation and they're really going through the portfolio and being very prudent, I'm comfortable with that too in this environment. But once again, as I always tell you guys, none of this is investment advice. Do your own due diligence. I just love to do the research and share my work on this channel. Now you're going to start seeing articles like this one come out. So this came out in June of 2023. The S&P Global says that commercial real estate loan delinquency rates rise sharply. So, of course, the headline makes you think, oh no, there's a real problem here. But, when you dig into the numbers, you realize, oh, it's not that bad at all. And so in the first quarter of this year, the commercial real estate loan delinquency rate increased by 12 basis points to 77 basis points. Now, the first thing that I would say is, generally I would expect around 1% in losses every year, maybe around 0.7 to 1. I think that's normal. When you start getting closer to 2%, I get really worried. Most banks provide at around 1.5 to 2%. And then, when you dig further into the portfolios, you see that for office real estate, they might have higher provisions. Like one bank that I bought, I think they've provided for 6% of a particular subset of their portfolio, which happens to be the office portfolio. So that's what I mean. And so, if, the commercial real estate loan delinquency rate for that particular bank is over or up to 6%, they're not going to take any subsequent losses because they've already provided for it. But it's just something that you have to look at. And so the other point is that when you start seeing headlines like this, ask yourself, what exactly does the data say? And I'm going to show it to you here. So the article is basically telling you that the uptick was 12 basis points higher than where it ended off in Q4 of 2022, which is fine. So that would put it right here. But when you compare that to the last 2 years, you can see that it's still running under where it was in part of 2021, the first half, and the back half of, or actually all of 2020. So the point that I'm making here is that the delinquency rate for commercial real estate loans is still within, the recent historical experience. However, anytime it starts ticking up, you should start paying attention more, I would say, and ask yourself, how are the banks that you're investing in, or how are the banks that you're looking to invest in handling this? How are their portfolios, loan losses working out? Like, are they increasing as well? Are they decreasing? And finding out why, and then addressing how are they providing for it. So the headlines that you read in the media are one thing. The next part of the analysis is, okay, well, is this sensationalized? And then the second part is, how does this impact the companies that I'm looking at? And you'll see articles that come out that talk about this. So this is the 2006 commercial real estate loan concentration guidance. And so there's two items of the guidance that regulators typically will look at. I don't think there's anything binding here, but it's just more of a, this will determine if the bank is of higher concentration in commercial real estate. So what are those two items? So the first one is construction loans totaling at least 100% of risk-based capital. Now, construction loans are the riskiest type of commercial real estate loans, I would think. And so it's important that they call that one out. So construction loans totaling at least 100% of risk-based capital. That's this purple line here. So you can see that there's been a solid trend up of construction loans being at least 100% of risk-based capital for certain banks. And then the second item that they look at is commercial real estate loans as a whole equal to at least 300% of risk-based capital levels, with at least 50% growth in CRE loans over the last 36 months. And so you can see that's this lower line here. Of course, it's a higher threshold to meet, but you can see that there, especially in Q2 of 2022, there was a big surge upwards, and then they will provide a list. But the first thing I would say is, okay, you see this increasing, so does this mean that there's some trouble on the horizon? I think for some banks there is, but once again, it is very company specific. Now I'll show you the list that they provide. So this is the list where they're saying the largest US banks that exceed the 2006 CRE guidance as of December 31st 2022, and this has been widely reported. I've seen many articles about this, and so this, I think, is the list to look at, as there could be some real value here if these names are sold off. Thus far, I've looked at one, which is Bank Ozic, and it looks like a great bank to me that I may buy if the price declines. Now, update, I actually ended up opening a small position in the bank, so I do own a small position now. But, the point that I want to make is, despite the analysis that I do, things could turn, and I could very well be wrong on this one. So I don't recommend that you guys buy it. Once again, I could very well be wrong on it, but when I did the analysis into Bank Ozic, what I did do is I looked into their commercial real estate exposure. I looked into the diversification. I looked into the culture of the bank. I went back and even looked at the resume of their CEO. In fact, the guy's been with the company since he was 25. He's 70 now, so he's spent his whole career with Bank Ozic. The point was that I really wanted to get an understanding of if I'm comfortable with the operations of the bank, how they've acted, and what their sort of like culture is at the top. And I'm very comfortable with this particular institution. And so I think, although it's high on the list, it's actually one of those banks that appear to be an opportunity. And, thus far it's worked out very well. Now, you guys might be interested in sort of like how I look at these banks, or how I sort of analyzed Bank Ozic. Well, I actually recently put out a video where I spoke about how I analyzed Bank Ozic and the different items that I looked at. And I actually pulled out information from their 10K to show you on how I answered those types of questions. For example, what do their deposits look like? What do the loan losses look like? What is their strategy overall, et cetera, et cetera. And if you've missed that video, no problem. You can actually get to that video. I think it's a very important video, and you can get to it right here.